Lee, Bill wants to squeeze one more question in before we go.
Yeah,
Sure.
Lee, you've always been known as a great stock picker. What do you like in here?
Well, I tell you, we just got a new account. And if you don't mind me, I'm going to put on my spectacles. I sent an email to my team. I have 17 high-quality analysts work with me. They deserve a lot of the credit. And I said, if you had to pick two stocks to put in this new account that we own, because we try to manage the money similarly, this is what came back. Apple Computer, Ace, BP, Broadridge Financial Solutions, Citrix Systems, CVS Caremark, Discovery Communications, E-Trade, Denbury Resources, General Motors, JP Morgan Chase, KKR Financial, which I think you own, Bill, Metropolitan Life, Magic, MGIC, Teva Pharmaceutical, Vodafone, Verizon. There's plenty of cheap stocks around. We're only limited by desire to control our overall exposure. Plenty of values around.
All right. We just were joking, Lee, we don't have enough disclosures for all of those names.
Well, go with the assumption we own them all, because why would I mention if we didn't own them?
All right. Well, thank you very much. And a lot of names. And for those of you who missed it, you're going to have to go back to the website, watch the interview again, because you'll hear all the names again. Bill's going to weigh in on a couple of those coming up, because they are coming up later in the show. Just ahead, another heavyweight joins the show. Brian Rodgers, chairman and CIO of Rowe Price, will join us.
Thank you, Aaron.
And I wanted to ask you your takeaways about the wireless conference, but I'm going to save the best for last. Okay. All right, let's start with a few of your, we were talking about gold at multi-decade highs. What do you think about gold? You got a new trade?
Yeah, I think gold's going higher, but I think the main thing is that when we break out of this this key level, you want to cycle back to the stocks. The stocks have been in a downturn because of the raw costs, how much it costs for them to get the stuff out of the ground. I think these are the prices, once again, where you have these companies that produce gold for under $400, like a GG. I think it can break out to new highs. And the ones that have had higher finding costs, like an Agnico Eagle, that have just been in the complete doghouse, you can go back to them.
All right, you like the gold. What about the silver? Do you share that same optimism on
Everybody
silver?
loves silver, and silver is cheap. But you know what? I think silver is much less gameable than gold. I'm a bull on silver. I don't want to get people wrong, but I just like to buy the ETF is my point.
Relative levels of bullishness too, right? Bull on silver.
Yes, but ETF.
Gold.
Let's use the ETF there.
Okay. All right, ETF on the silver. Okay, another name, Jim, that keeps hitting high after high after high. Some people say, gosh, it's overvalued, it's out of control. Cat, you disagree?
Oh, yeah. I mean, look, I think the stock should be at 125. I think this company's earnings power is just rather extraordinary. The one thing I was worried about was the generator business, because I know there's a truck shortage worldwide. Well, I mean, is there a limit to the number of generators that Japan needs? And the answer is no. Caterpillar is the most exciting stock in the Dow Jones average.
Well, hey, you know what? When Japan doesn't need them, Nigeria still will.
Oh, yeah. I mean, no, this is an amazing company. I urge people just go look at the annual, and you can see the lineup they have. Don't forget the dollar's weak, so they've got the competitive advantage. It's very rare in the world when you have the cheapest that is also the highest quality, and that is Caterpillar. Remember, they play it very close to the vest. They're not braggarts. They are the best manufacturing company maybe on Earth, but certainly in the United States.
All right, so Jim, I don't know if you heard Lee Cooperman. At the very end of his interview with Lee and Bill Miller, he listed off a whole bunch of names, which I told people they got to go back on the web and watch the interview to write them all down. But one of them was Apple, which you like. Right. Another one was Teva, which actually is on your list today.
Yes. I mean, OPCO cut numbers. Well, first, let me just say, I have been in awe and have loved Lee Cooperman since I first met him in 1983. Going against Lee Cooperman has been a sucker's game all my life. I was frantically writing these down until you reminded me, no, you can replay it. Teva numbers got cut today by OPCO, and the stock went up. That's a bad news bottom that I've been waiting for. People do not understand the power of this company. They're too worried about Copaxone, the multiple sclerosis drug, having competition. Teva is dirt cheap, and I think that Lee is dead right. And I've been against it all the way in the 50s.
Bill Miller was nodding his head, too, on Teva and him looking at Teva. All right, coal, Jim, you also still think that's going
Yeah, I mean, look, when I was down at CTI, people just want to keep asking me, Jim, are you still bullish on coal? So you're still bullish on coal. I want to emphasize that coal is a 2011, 2012 story, that we are a coal-based nation. Our president is deeply committed to coal. Yep. The utilities are committed to coal. The lobbyists are committed to coal. Our president likes this dirty fuel among all other fuels other than nuke, which is never going to be built in this country after NRG said this morning that they don't want to.
All right, before we go, what's your top takeaway from the wireless conference? Because we're about to sit here and have a big tech conversation.
I cannot believe how undervalued AT&T and Verizon is. I don't like to overthink this. These companies have huge dividends, and they've got great growth, unbelievable growth. I would buy them both right now aggressively.
All right, Jim Cramer, thank you.
Thank you.
And welcome back. I know it's a lot of traveling. And tonight on Mad Money, Jim's highlighting a high-flying stock. You will find out what that stock is if you watch tonight And you'll also find out about Iridium, which I believe maybe that's stock or maybe it's another one, Matt Dash. Sorry, Jim. I tried to keep a secret. Okay. Now, what is the next big thing in tech and how do you get in on it? It's the big question everyone has when they're talking about the cloud or social media or the next hot tablet. Joining us is Bill Gurley, general partner at Benchmark Capital. Bill was requested by Bill. This is one of Bill's guests. And Bill Miller wanted him to talk about what is the next big thing. So Bill Gurley, we thought we'd start off by asking you, what is the hot thing in social media right now?
Well, we're actually seeing three different areas that I would describe as hot areas that we're particularly excited about the disruption in. One is the cloud, so moving the compute infrastructure from inside the enterprise to outside the organization. The second one you mentioned, social, where humans and the human network are being leveraged for content creation and curation. We're in companies like Twitter and Quora. And then the last one would be local. We're seeing quite a bit of activity around using the internet and new technologies like smartphones and tablets to go after markets that previously haven't been attacked before.
Bill, I think I saw this morning you made some comments. Jim just talked about the AT&T T-Mobile deal, and I think you made some comments about that today. Could you elaborate on what you said?
Yeah, I just said that it's already become very difficult for venture capitalists to invest in things like telecom equipment or wireless data equipment because when you have an oligopolistic structure, it's really hard for a new provider to break in and provide those services. So further reinforcement of that oligopoly just makes it a sector that's really hard for venture capitalists to invest behind. So I eventually think that would hurt innovation, but that ship may have already sailed.
You each have totally different perspectives on this issue of valuing companies that aren't public yet. All right, so let's talk about Facebook just as an example to get each of your views on that. We had pulled together just a little chart here based on the public reports of what Facebook has been valued at, all private market. In the past 4 months, Facebook's valuation is up 86%. Since 2006, it was at $1 billion. Now it's at $65 billion. Two different perspectives. Bill Miller, first of all, what do you think of this?
Well, full disclosure, I actually own some Facebook shares, purchased it lower than the $65 billion valuation.
You're one of the lucky ones then, yeah.
But I would say that if you think about this, I mean, we were one of the largest investors in Google on the IPO, did Amazon on the IPO, did Bill's OpenTable on the IPO. So I think we know a little bit about the valuation of these businesses. And Facebook, there's not a lot of information out there yet about the financials, but it's very clear it's a completely unique enterprise. It has more active users than the U.S., the largest economy in the world has people. And those users have a personal relationship with Facebook. You can access them. Right. You know, we've seen some numbers that perhaps they might do $5 billion of revenue, and that's without trying to monetize things. You know, Zynga's setting up almost a symbiotic relationship with Facebook. But broadly speaking, and I'll just I'm going to oversimplify the valuation probably maybe more than I ought to, but to say, if you've got a business with a massive global addressable market that's growing roughly 100% a year as they are, with a terrifically scalable model that can earn, call it, at least 30 to 50% operating margins, then 10 times forward revenue is not too much to pay for that during the high growth phase. And so if their revenue is going to be around $5 billion this year, 50 is not that great. Putting it differently, you can look at companies like Google, called 160, 170 billion of market cap, and think that Facebook, when it comes to market, and then when it, probably in 2012, Bill may know better than I do on this, but broadly speaking, it's going to be a very attractive thing for people to own just a piece of. So, you know, I've no special insight into how it's going to trade or what's going to happen, but given the size of the addressable market, $50 billion does not sound like an outrageous valuation to me.
Bill Gurley, what's your take?
Well, I don't think anyone can deny Facebook's strategic position in the market. All the things Bill said are particularly true. The amount of secondary shares that are trading in a broad number of names out in Silicon Valley, as well as the intensification of the number of participants that have run into that market and the complete lack of information that Bill also referenced. I would just say I'm not sure you can trust everything you read on all these different valuations. Some of these investors are working with less information than you'd have on a Canadian pink sheet company.
Bill, you mentioned the cloud earlier. Some of the old tech names, Microsoft, companies like Amazon, IBM, are very active in the cloud. How do you see that? How do you see that playing out in terms of those big tech names? If you have a view on that.
Right. So, the trend, I think, is undeniable. As I said briefly in the intro, we spent the last 30 years putting computing technology into the enterprise, and we're going to spend the next 10 pulling it right out. For small and medium businesses, having this stuff on site just doesn't make sense now that we have the bandwidth that lets it live in a more scalable place. I think from where we sit, which is looking at how startup companies are using these technologies, Amazon's clearly in the pole position. AWS is priced extremely low. I think Bezos likes to say, I know how to run a low margin business, and I'm going to do that here as well. That's a pretty distinct position relative to the other companies that are preparing offerings in that market. And they've also just been super helpful in terms of reaching out to the developer community and making sure that their needs are being met. So a lot of our companies like RightScale, like Eucalyptus, that are providing add-on infrastructure in that marketplace, are providing tools for the enterprise. Most of them are focused on leveraging AWS and or extending AWS.
You know, it's funny you mentioned that. I had a conversation with Jeff Bezos about this maybe a year or so ago, and I was talking about about the so-called attractiveness of the AWS, the Amazon Web Services business, and I said, Jeff, that should be a pretty good margin business compared to books, and he said, I hope not. And I said, what do you mean? He says, look, I'm not gonna do what Steve Jobs does and price this stuff up so that I subsidize the world's R&D effort against the cloud. I'm gonna price this at a low enough level that it's going to be very expensive for other people to duplicate what we do.
Quickly before we go, Amazon. I know you had commented to me before it might be expensive. What do you think?
We own Amazon. We've owned it for a long time. I think our average cost is around $9. And again, I think it's a unique global business. It's not inexpensive now, but it's also a business. If you look out 5 or 10 years, it's hard to see how you're not going to do pretty well owning a company like Amazon.
All right. Well, thanks very much to both Bills. We appreciate it.